You will regret getting a mortgage in 2024 if you make any of the mistakes that we talk about in today's video. As interest rates have moved up, housing affordability has gone down. We see more and more home buyers almost desperate to get a mortgage to buy a home. And with that, we're seeing a lot of mistakes made during that process. So Josh, let's spend a little bit of time today and actually talk about those mistakes in detail because as you and I said, if you make any of these mistakes, you're really setting yourself up for failure. And if not failure, a really difficult process. So with that, let's start with the very first one.
Absolutely. And this one, Jeb, getting more and more and more. I actually had a buyer tell me last week that the realtor that they were working with told them, I don't know why your lender needs so much time. 14 days is typical of what we're seeing for escrows in the current market. So just so you know, like the waiting periods built into the TRID guidelines from 2014, 2015, whenever those got rolled out, you can't close a loan in less than 8 days. But 14 days is basically everything going perfect. And I don't mean just on the loan side. We have to get an appraisal back. So in an area that's not rural, where you have a lot of appraisers, you can generally get an appraisal back in 5 days, but we need to get your disclosures out the first day. So just maybe I'll back up, Jeb, and walk through what this timeline looks like. As a lender, we are held responsible to everyone's numbers. So we make the disclosures to you. The loan estimate comes from us, and we're the ones that are held responsible for any tolerance cure. Meaning if I tell you title insurance is going to be $12 and it ends up $2,012, this guy gets to eat the $2,000. So for that reason, we reach out to title, we reach out to escrow in your neck of the woods, whoever's handling settlement, and we say, hey, can you get us third-party fees? That takes time. They're not just sitting around waiting for your contract to come in. So they get the contract, they open the escrow. Many of them, until your escrow deposit goes in, will not provide those fees. So there is a workaround. The workaround is we way over disclose everything to you. So your loan estimate is not accurate, but it's safe for us. We've estimated every third-party fee to the high side. Any way you cut it, there's a timeline in waiting to get that information, to prepare your disclosures, to get them out to you. Now, once they go out, most buyers, Jeb, aren't just sitting there going, oh, cool, these numbers are great, DocuSign, 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 done. They go, hey, everything looks pretty good, but this didn't make sense to me. What about this? What about that? So we have to schedule a few minutes, go through it on the phone. We get everything DocuSigned. From there, now you can be charged things. We can order the appraisal. If it's someone that is local, someone we have a past relationship with, that's not, someone that just found us online, then we'll just go ahead and order the appraisal on our dime to not lose that time. But from there, 5 days to get that back. So in a perfect world, first day, we get your contract in, we get your disclosures out. You get them signed. The next day, we get the loan submitted. And 48 hours later, the approval is back. So again, if we did, we're going to talk about this, a rock solid pre-approval, we had almost everything that came that the underwriter was going to require. We can get that in 4 to 5 business days. So now we're talking about there's going to be conditions there. I had an almost perfect file come out of approval yesterday, a listener to the show, and we had one condition from them. There's 4 or 5 things that we need to work on from our end, but one thing we need to get from the borrower. He got that to us last night. So it's a day, right? Now it goes back and it's 24 to 48 hours to get that cleared by the underwriter. Once that's cleared, now we can order the docs. So the docs are going to take 24 hours. Sometimes we can rush them same day, but you're starting to see that 14 days is absolute and utter perfection. I've closed a loan recently in 11 days, another one in 12 days. What I want to tell people is this is going to be a stressful process. When you want to add that pressure onto it, you are making it exceptionally stressful that the appraiser has to go and get out there quickly and deliver on time with a clean appraisal. There's not any conditions, nothing they have to go back out and reinspect. Your approval has to be clean. You have to do all of your steps, signing your disclosures quickly, getting us your conditions quickly. All of that has to fall in line. And on top of that, Jeb, I want to turn it over to you at this point because you have things that you're doing on your side, an inspection, negotiations for repairs, re-inspecting those repairs. 14 days, it's just the faster you try and do something. If you rush through something, you are very likely to make a mistake. Home buying, getting a mortgage is no different. What are your thoughts on that?
Well, I actually just want to back us up and kind of be clear on what the mistake is. The mistake is a buyer and or a real estate agent suggesting to a buyer that they shorten the contingency periods to some crazy time frame, say 14 days from the time of opening the escrow to the time of closing, without actually verifying that information with the lender that they can accommodate those timeframes. So what we're saying here is that, hey, Josh is my client, and I say, hey, Josh, in order to be competitive here, I think it would be smart for us to shorten the escrow period. Instead of a 30-day, which is typical, let's do a 14-day, because that'll make us super competitive. The house is vacant. We know they want to close quickly, so let's be as competitive as we can. And the mistake is I never check with lender A over here to verify that lender A can actually accommodate those timeframes. And what that does is that sets everyone up for failure. It sets Josh up for failure because he's just handed a contract that says these are the time frames, and he's never actually said committed to any of that. All right. There's no commitment to say, I can do this. It is handed to him and said, hey, this is what we need you to do. And then when Josh doesn't do it, it's me bitching at Josh because he's not doing his job properly. And as somebody that's been on the mortgage side, I think I have a lot more leeway, a lot more sympathy, if you will, on that side, because I know what it's like to be on that side. And that's why it's important to start that process by checking the lender. Hey, how quickly can we get the appraisal? How quickly can we get loan approval? Are we in a position to shorten contingencies? Are we in a period to close quickly? And then if it flips onto my side, and this is really about the mortgage side, but think about the real estate side. Here in the state of California, you have 6 contingencies when you buy a home, assuming you're getting a loan. You've got an appraisal, you've got a mortgage, you got the loan itself, you have a home inspection, you've got seller disclosures that you get to review. If the property's in a homeowners association, you get HOA docs. And let's be honest, sometimes just on the HOA docs alone, it takes 10, 12, 15 days to get these things back. Even if you're paying a rush fee, and it seems crazy, but HOAs, they work at their own pace, and a snail's pace in many cases. So you're setting a lot of these timeframes up with the expectation that everybody is going to cater to you. And it's, quite frankly, it's not reality. So I think that's me diving into it.
Well, Jeb, let's walk through an example. That example that I talked about, the agent said, hey, we're seeing 14 days is common.
Yeah.
And I said,
let me stop you for a second, Josh. Can 14 days be done? Yes or no?
That's exactly what I was going to say.
Yeah.
Yes, it can. I can do it for almost any borrower. Some of them, we're going to talk about a complicated situation I have right now. There's no way we can close that deal in 14 days. 90% of borrowers, their situation is straightforward enough that if we have to, we can close in 14 days if everyone is pulling in the same direction. Right. But we can't do that for every borrower. Any lender on the planet that says we're closing every loan in 14 days, everything, you're prioritizing things. You're moving things in front of others. Either that or you are grossly overstaffed, which I don't know of any mortgage company that's overstaffed right now, other than a few direct lenders that's their pitch. They tell you, hey, we're going to get your loan closed in 10 days. You can write a 10-day escrow. Well, they're also 0.5% out of the market, and they use that extra money to pay the staff sitting around twiddling their thumbs waiting for that contract to come in. So let's look at this situation. The borrower whose agent told them 14 days is common. So we're having a conversation. Look, you guys are solid. You've got me everything. You're on top of this. I said, but your parents are co-borrowing for you. I know them and I know they'll get it, but sometimes they drag their feet a day or two. We don't have that time. So as long as you stay on top of them, they get us everything in a timely manner, we're good. So what happens? They miss out on the property they're bidding on. The following week, the bidding comes through. They do the same thing. They write that same 7 days. Well, the contract gets signed Wednesday night with 7-day contingency periods, meaning we have until today, 7 days later. Well, let's look at what happens. Wednesday is cooked. The contract was signed at night. I get it Thursday morning. So we have Thursday to get fees, get disclosures out. Friday, we got the appraisal ordered. Okay. So Friday, the appraisal was ordered, and I believe it was scheduled. Well, the listing agent couldn't get the people into the property until today. The appraiser got in to inspect the property. But yesterday, I get a call that says, hey, tomorrow's 7 days. Are we going to be in a position to release the approval, the appraisal and loan contingency? I said, well, let's back up a second. I said, I got the contract Thursday morning. So I had Thursday to work on it. I had Friday to work on it. And then it was a holiday on Monday. And here we are. So we've had 2.5 business days. I said, do you know anyone that's getting loans and appraisals cleared out in 2.5 business days? I don't. I mean, is it possible if we dropped everything and prioritized this one loan? It certainly can be done, but that's just not the reality. Everyone is busy relative to the staffing that they have. So if you hear a lender saying, hey, we're busy or we're backed up, and you're like, well, that's crazy. I'm looking in the news that sales volume is at a low since 1996. So we were on 28 years. Yes, that is accurate, but everyone cut back their staffing as well. So in terms of loan volume to head count, everyone is very busy. Right. So in that situation, that realtor said, okay, no, I totally get it. I'll go back and I'll explain to him, and hopefully we can get it Thursday. And we're probably going to be at 8 days. Worst case would be 9 days Friday. And we'll be absolutely on track for a 17, maybe a 14-day closing on that loan because everyone has been pulling in the same direction. So part of the negative part from a lender's perspective, hey, you got these realtors breathing down our neck. But the good part is those realtors are doing their part because they want it to close in that time. They're not sitting there working against us and asking if we're on track. They are also moving in that direction. So long way of saying on that, it can add additional stress, and you need to make sure everyone is on board and working in that direction. And I, as a lender, if I get an agreement that we're all doing that, I'm going to be reminding everyone every other day, hey, this is what we're all doing to make sure we get to that timeline.
No, good stuff. Now, before we dive into the second one, I'd like to take a minute and ask a favor. If you find any value in the content that Josh and I do here, support the channel, do us a favor and hit that thumbs up. And if you haven't done so already, subscribe to the channel to stay updated on everything mortgage and real estate related. So Josh, the second one is my favorite one because this has kind of been in the news not in the news, but it's been a hot topic for the last year and a half when rates have been moving up. And it's this idea that rates are going to improve, and they're going to improve substantially sometime in the near future. Now, both you and I we both thought that interest rates would have improved by now, but the economy looks a little bit stronger than both of us had initially perceived. So with that, I guess the mistake is that people going into the process with the idea that things are going to get better in the shorter term to make the mortgage more affordable. Therefore, hey, I'm just going to get in now. I'm going to buy the house now, and I'm going to, in theory, marry the property, date the rate, which I absolutely hate the saying, the quote, but that's the idea that, hey, it's going to improve. And then now the relief, I can actually afford the mortgage. So what are you seeing on that side?
Well, how it works out, we do a lot of second opinions from the podcast here, from the live show that you and I do, from your 100,000 subscribers. People will reach out and you say, I'm not sure of what I'm hearing. And many of those people are telling me we're doing a 2-1 buy down. We're doing a 3-2-1 buy down. So, okay, why? Well, we need rates to come down, and this will buy us some time till, give us 12, 24 months. So when you look at it, it does do that. It buys you time, but you're making an assumption that you're going to get that opportunity. Now, if I were a betting man, would I say in the next 24 months, we're going to get a refinance opportunity? It depends on what you define a betting man. I say 60-40 odds. Better odds, yes than no, but that's also not the type of Russian roulette you want to play. You're going to put a bullet in your head and risk, a catastrophic ending. So from that perspective, you can hope for it, but you can't plan for it. And that's my issue with many loan officers that these people are talking to, saying, okay, we know for a fact rates are going to be lower in the next couple of years. We can do this 2-1 buy down. In our market, we can get the seller to pay for it, and you basically have this subsidy. Well, it is a subsidy, but it's smoke and mirrors. The seller is willing to pay. A 2-1 buy down costs a little bit less than 2% of your loan amount. If you're doing a 3% down, 3.5% down, basically you're asking the seller to give a 2% reduction in the price in the form of a concession to you to pay for that. Well, it doesn't really pay for anything. All it does is it goes into an escrow account that is used to subsidize that lower payment that you're going to make for the first 24 months and then slightly lower for the first 12 months. So all we're doing is just moving numbers around. We could have got the home for 2% less. We could have taken that 2% and bought the interest rate down 0.5% and guaranteed that we will have that for the life of the loan. And I'm not suggesting that. I'm saying that when I talk to these people, it has rarely been laid out for them what all of those options are. And there's no wrong decision. The right decision is what feels right to you. The wrong decision or the mistake here is saying, okay, if rates were 2% lower, we can afford this house. we can do the 2-1 buy down and my rate is 2% lower. Well, yes, but for only 12 months. 12 months comes up pretty quickly. Just last October, Jeb, I've been in my house 22 years, and we looked up and go, where'd those 22 years go? That first year flies by. So a 1-0 buy down, a 2-1 buy down, a 3-2-1 buy down. It buys you a little bit of time, but if you have to have that lower payment at the end of that to be comfortable with the payment, you are making a mistake.
Yeah, and what I'll say is time is entirely different. It's entirely different than 2008. But back in, part of the debacle that happened that caused the housing crash was short-term adjustable rate mortgages. And now, again, those are out of the market, so they're not here now. But it was this expectation that, hey, I've got this thing fixed for 2 to 3 years. In 2 to 3 years, rates are going to continue to be lower or trend lower. I'll be able to refinance this and everything's going to be okay. When in all reality, 2 to 3 years went by pretty quick and that opportunity was gone. And so I don't want to relate the two, but I want to make it clear that not everything goes the way people think it's going to go. And therefore, you need to be buying and getting a mortgage based on your situation now and not some perceived, change in the market that's going to make it more affordable or make it a better position for you, that your home value is going to go up and you're going to be able to get rid of PMI, or that rates are going to drop and you're going to be able to refinance and now it's going to be affordable. Buy with the expectation that this is what it is. And if an opportunity presents itself, you're in a golden position to take advantage of it. So, Josh, our third one here on the list, I actually want to move to 5 because I think it's probably the most important in my opinion. So let's save it to the end. But the fourth one, which is now 3, so 4 becomes 3, is doing what we call a half-assed pre-approval. That's exactly what it says here on the piece of paper. And so when I say that, Josh, what comes to mind on your side? Or who comes to mind? Who comes to mind when I say half-assed?
So we have a listener to the show. We have a listener to the show that we took over their loan here in the last week. They're under contract. They actually had a loan approval, but they reached out because they said, you know what, we're just not getting answers from our lender. We ask questions and they kind of blow it off. Oh, that's just a rough estimate. We're going to tighten up the numbers later. Everything's going to be fine. We have your loan approval. Send this stuff over. I said, okay. And before I'd even spoken with them, they were proactive. They stepped in and had done an online loan application. So I'm looking at it from the online loan application. Everything looks good, but we had a lot of moving parts. We had a job change last year. We have pay stubs that don't show 40 hours every week. We have one of the borrowers self-employed and has only been self-employed since the middle of 2022. So from all of that, there's actually more moving parts. They were doing a rapid rescore to get the credit score over a 640 to get the FHA better terms. They have not documented their funds. So this wasn't just a pre-approval. This loan was in process and this lender told them they were approved. And I said, please forward this to me. And you could tell it was a direct cut and paste from the biggest wholesale lender in the country. And different lenders approach things differently. Some of them will give you an approval and let you hang yourself on the conditions. Others will look at it and go, there's 5 make or break conditions in here. And without them, we don't have an approval. So they'll issue what's called a suspense. Still gives you all the conditions and lets you know everything they're looking for. But it doesn't give you this illusion that you have an approved loan. It says, hey, you might be able to get approved if you can get past these 5 things. So in that situation, literally everything about this loan should have been front loaded. We should have had the 2-year work history. We should have had the final pay stub from the last job. We should have had the letter from the employer showing that she's guaranteed 42 hours a week and a portion of that is overtime. We should have had the LLC creation documents for the business to show the exact start date. Any number of things. There were literally like 10 things that, to the borrower's credit, they're awesome. It wasn't them. They were not told, hey, these things are essential to the process. When I ask, within 24 hours, they go track it down and I have it in my inbox and all of our ducks are falling in a row. So the reality is they quite possibly could have got this done with the other lender, but they were having to go, well, what's next? What's this? Is that going to be a problem? Is that going to be an issue? And every step of the process was as simple as front loading it, doing everything up front. And I have another example. That gentleman that I got the approval for yesterday that had one condition. Generally, the people that have the real simple situations are the ones that are super worried about their approval. So they want that rock solid pre-approval. They give you everything and all of your ducks are in a row. And it doesn't mean that the other borrowers are bad borrowers or they're dumb. Just people don't do mortgages all the time. And kind of your personality says, hey, I know I make this much money. I know I have the money for the down payment and closing costs. I know my credit score is up above 620, so I'm eligible for FHA. So all of that is just assuming that everything's going to be okay versus we don't want to assume anything. When we give that pre-approval letter out, we want you to know, you, the realtor, you, the borrower, that it is 100% rock solid. And Jeb, this is the mind-boggling part. We've said 1,000 times here on the show, there's 3 important parts to the pre-approval. 1, do you qualify and what is the max purchase price? Mm-hmm. 2, how much money do I need to have? And number 3, what is that monthly payment? These borrowers knew nothing other than, yes, you're pre-approved. They thought they were getting a conventional loan and the disclosures come out and it's FHA. They thought they were paying 0 points. It was 1.5 points because the rate couldn't go above a certain rate to keep the debt to income ratio in line. So that front end pre-approval can be very simple. If you have a simple situation, it can drag on and have some back and forth. Basically, the back and forth that she and I have been doing since last Friday should have been the pre-approval process. When you do the pre-approval correct, the process of getting under contract should be a non-event because now we're just connecting the dots. My job, my team's job is to pre-underwrite that file, see around every corner and anticipate everything that the underwriter is going to need so that we don't get blindsided by something that we either can't meet during the process or that is just super stressful and difficult.
Yeah. And this is where I want to make a point. People often come to me to buy a home. They're not pre-approved. And I recommend, Josh, I recommend a lender that I feel strongly about, that they're professional, that they know what they're doing, that they're going to be able to, like you said, look around the corner. They're able to connect all the dots. And people often take that as, hey, I'm just referring my friend, or I'm just referring this guy because somehow I'm making money off of it, which is actually illegal via RESPA. But I'm referring you to the person that I know is going to do a good job, that I know is tackling everything up front, that we're not going to have hurdles down the road and having to deal with all this stuff while we're in escrow. So it's important to go with somebody that is trusted. But I can tell you, there are realtors that will refer you to their buddy or to someone that doesn't do the good job. Oftentimes, Josh, people that you're talking to are getting that you're correcting the mistakes were referred by a realtor to someone. So it's not always a good referral. Just understand that. But it's up to you as the borrower to, look at communication, look at, the questions that they're asking, look at all of that information and be able to make a decision. And sometimes that's why it's smart to get a second opinion, talk to another lender, just so you have something to compare it to. Are these two lenders asking the same questions, or is one digging a little bit deeper? Why are they digging deeper? Is it because no lender wants to do more paperwork than they have to? I think that's one of the things that's, that borrowers say, well, why are you asking this? I'm asking for it because it could be a problem, not because I want more paperwork. The last thing you want to do is deal with more paperwork. And the reason I bring this up is because this solidifies the deal. Pre-approval is the most important piece. So with that, if you are going through the process, you need a second opinion, you need a first opinion, and you'd like Josh and our team to help, there's actually a referral link in the description of this audio, of this video, that can connect you with Josh, his team, that can guide you through that process, answer your questions. If nothing else, it's just solidifying that what you have is a solid deal and to move forward with it. And if it's not, then Josh is going to ask the right questions to help guide you through that process. So with that, Josh, let's move along to 4. 4 kind of goes along with 3 in some way, and that it's complicating the process, not by not front loading the paperwork, but by doing things during the process that create issues. And or I guess it could come before, but what are we talking about here?
It can come before because, Jeb, a lot of what I'm seeing is people that are kind of aware, people are educated, and we may be biased or jaded in terms of the people that we hear, because if someone found us on YouTube, through your YouTube, through the podcast, That's someone that is proactively educating themselves. So they have an idea. They don't have 30 years of experience of doing mortgages, but they have an idea because they've gone through it. So we'll have, okay, I know that the cash at home wasn't okay, so I put it in the bank. Okay, when did we put it in the bank? Well, that's still going to be an issue. So a lot of this isn't like errors of not knowing. It's waiting too late in the game. So if we need to pay off debt, if we need to buy a new car because our lease is coming up, if we need to move money around, you want to do it as early as possible, because we really don't need documentation back, with FHA, with VA, with Fannie Mae, with Freddie Mac, not Fannie Mae. We can do 1 month of bank statement. Oftentimes with Fannie Mae, Freddie Mac, we can do 1 year of pay stubs and W-2s, depending on your income structure. So there's ways to work within the guidelines to work around almost anything, but doing things right in that window, like in a perfect world, 90 days before you're ideally going to close on your home, maybe as much as 120 days, you've kind of set everything in stone. I've put the money in the bank account where I want it, where I'm going to have it coming in from. I've, not going to change jobs. I have a great offer, but I'm going to wait until I close on this, which that may or may not be a problem. Any of these things may or may not be a problem. We're talking about simplifying your life. So if grandpa comes in the 11th hour and gives you a $100,000 gift, we don't say, don't do that. We say, okay, well, here's what that means in terms of documentation. If we said, hey, we can avoid mortgage insurance if I take a 401k loan, I'd rather do that. So now we're going to document that. Now this money's moving around. We just talked about a job. You have this job offer and you're like, hey, didn't want to make a move, but it's a step up and I'm going to be making $2,000 more a month. You don't want to risk missing out on that. But to the extent that it's possible, 90 to 120 days before, we've kind of put a stop to all of that. And if any of it comes up, an opportunity to improve your situation, now talk to your lender that did that rock solid pre-approval for you. And you may be saying, well, I'm 90, 120 days out. I haven't done the pre-approval. That goes back to where we say it is never too early to do that pre-approval, so we can have these conversations. Because a lot of times borrowers know, well, this might come in, or I might do that, or hey, this person that I used to work for just got a new position. They want to pull me over there, and we can game plan and get a path ahead. None of those things are deal killers usually, but they certainly are delayers and stress adders to the situation.
Well, I want to go a step further and talk about, as a real estate agent, receiving an offer from a client who made an offer on a house that I had listed, and they submitted over the paperwork and they gave me the pre-approval. And with that paperwork, we often ask for proof of funds. Like, hey, you're making a 20, 25% down payment, whatever the number is. We'd like to see proof that you actually have the money in the bank, right? That if it's a gift, that's okay. Just tell us where it's coming from. But if you say you got the money, let's see the money. This agent, who was actually representing themselves, had the pre-approval, sent it over, and sent me 16 bank accounts. 16 bank accounts, and gave me 2 months for each bank account. So she sent me 32 PDFs of where the money was going to come from for the down payment. I'm not a loan officer, but I looked at that file and said, whoever's doing that loan is going to hate that person. Like, it was a solid offer. They made a really good offer. Fortunately, somebody came in with a better offer and we ended up accepting the better offer. But that client was on the table as somebody that we were going to consider. And I thought, from a pre-approval standpoint, that's a nightmare. Like, whoever's dealing with that on the other side needs to give them some advice that they need to get all of that figured out versus, all of this craziness, because it just creates additional problems down the road. So one small example, but there's a lot of them out there like that can be prevented by working with a professional, doing your homework up front. Now, Josh, here's the one that I think, to me, is the most important. You might disagree, but we'll get your take on it. And that is waiting until the last minute to shop lenders. Now, that could mean that you're already in escrow. You've already got a contract accepted. Now you're starting to shop around. Who am I going to go with? We've only got, 14 days to close the loan. Who am I going to go with? Or in some cases, Josh, we even go a step further and say, you've done your homework up front, but you've spaced out the shopping. So you did one on day one when you originally got your pre-approval, and then 2 weeks later you talked to another lender, and now you're debating between two, and it's not really a fair comparison. So when I say that, Is that the worst one out of the five, or is that just kind of fall along in the same order as the others?
It's the most recoverable, because let's say you did that rock solid pre-approval ahead of time. You can kind of throw off the process by screwing around for a couple days and making phone calls and lose 2, 3, 4 days on the front end. But if we have a 21-day escrow and you lose 2, 3 days, we're probably going to be okay. 30-day escrow, not a problem. But here's the thing. What I always want to put into context, and at risk of sounding like a broken record, if your focus is getting the absolute rock bottom lowest interest rate, first of all, you're probably not going to get that. And you are more likely to paint yourself into a corner by going with the huckster salesperson who is promising the lowest rate. The reality of the situation is, if you are committed to me, let's say I am the lender with the absolute rock bottom lowest rate, and you are committed to me, the odds of us getting your contract in a position to lock and locking on the absolute rock bottom lowest day of the 21, 30, 45 days that you're in escrow are minuscule. So if you're focused on, oh my God, I absolutely positively have to get the lowest interest rate, you probably shouldn't be buying a house. If it is that dependent on having the absolute rock bottom lowest interest rate, because I can tell you, people's brains work funny. We talk about risk tolerance, whether you're going to lock or float. And when rates are going up, they want to lock. And if they get better, they want to know how they can float down. If rates are going down, they're going to wait until they start going back up, because they don't want to, not let it fall all the way to the floor. So that's if you're committed to one lender. If you were to try and do that process with 5 lenders, let's say 5 lenders, that would be insane. We've talked about this on the show, Jeb. I don't think anyone should shop with more than 3. Pick 3 very different sources, a broker, a bank, a credit union, something along those lines, and get numbers from them on the same day. We talk about reputable lenders, all should be within a very narrow range. And your decision should be, once you find 2 to 3 reputable lenders that all are in a narrow range, so you've confirmed that is what my pricing should look like, you need to pick the person that you connect with the best, that you communicate with, that hears, understands, and educates you. Then you need to make sure they have the knowledge and expertise. There are people out there that are very friendly, very awesome, you would connect with wonderfully. They've done loans for 5 minutes, or they've done loans for 10 years, but they've really done it for 6 months, 20 times in that 10 years. You need all of the above. No one should not get a competitive interest rate and reasonable fees. So that's one important leg of the stool. No one should have to deal with someone that doesn't deal with them or communicate with them honestly, accurately, forthrightly, and on a timely manner. You deserve that. And then the last piece, everyone deserves an expert. And when they are few and far between. In this industry, 80-20 is probably an understatement, more like 90-10. And if we say 80-20 of the 80-20, it tells you that top 20% of the top 20% is who you really want to work with. They are hard to find. You said it on an episode 2 weeks ago. There's a lot of them. We got a buddy of ours that's 3 doors down from us. He's awesome. You would get just as good a loan from him as you would from me. So I'm not telling you I'm the only one on the planet. I'm telling you, you have an 82-95% chance of not getting that. So you have to trust your gut, and you have to do that early in the process. So we can say, if you call 3 lenders during that pre-approval and you do it exactly right, one morning at 9 a.m., you call 3 lenders, you say, I'm doing an FHA loan, $400,000 purchase. I have a 720 credit score. What are my rate and point options today? And you look at all of them. All 3 of them are in a very narrow range. And you go, well, one seems very knowledgeable, but he's stuffy and we don't communicate. The other one, she's super friendly, but she's been doing this for 6 months. I'm not comfortable. And the other one, we got along really well. They seem to know exactly what they're doing, and their rates are as good as anyone's. Go that route, because we talk about that rock solid pre-approval. Now we have to do some work. You have to do work in getting me the documentation. I have to do work. So you can't lock anything until we get that contract in. I mean, there are lock and shop options, but we've talked about the downsides of that and the reason why 98%, 99% of people don't do that. But if you go, hey, awesome, you did this rock solid pre-approval. You wrote me 23 pre-approval letters. You followed up with all of the listing agents. You helped me get that offer accepted. Now I have an offer accepted, and I called Jane down the street, and she can do it for $500 less. She can do it for $2,500 less. Remember that it's always easy to come behind someone else and say, hey, this person that did all this work for me that I know is knowledgeable and trustworthy and had competitive terms with all of those that I checked. Really easy when all of the work is done and they hear pre-approved buyer under contract, hey, will you do it for less than this? That's a super easy thing to do. I don't know about you, but I don't wait till the day of my surgery and go, hey, is there any doctor who had a cancellation today that would do my surgery for $5,000 less? You're not going to bleed out on the table with a mortgage, but financially you are going to have risk of dollars, risk of stress, headaches, hassles. So it's a bigger process. It's not as easy as shopping for the cheapest price on a pair of jeans that's the same no matter what store you buy it from.
No, good stuff. And if you're listening to this, it speaks to you. Want to talk to Josh, his team, referral link in the description below. Check it out. Josh, when I hear you talk about that, there's a quote. I don't know who says it, but I use it often. And it's everyone is a professional until you actually need one. And the internet is full of professionals. I mean, holy cow. It's amazing the comments and things that we get as somebody that's combined. We've been in the business almost 50 years between the two of us, but yet there are people out there that aren't even 20 years old that know everything better than you and I. So, again, just make sure you're working with a professional. Make sure you're getting competitive terms. Make sure you're comfortable with the process. That's really what you can control. Control what you can control, and let the mortgage professional, let the real estate agent do the rest. So, Josh, we've been through 5 big mistakes. Are there any bonus ones you want to add, or, is that it?
Probably the biggest one that I see right now is people getting hung up on wanting the biggest down payment to the extent that, hey, I don't want to have mortgage insurance, or I want to minimize mortgage insurance. Mm-hmm. And then the other piece of that is, no, I'm comfortable carrying this debt. I qualify with it. I want a bigger down payment. And in the grand scheme of things, unsecured debt on credit cards versus secured debt on your mortgage, you want the mortgage as small as possible. That's reasonable. But again, going back to the knowledge and expertise, your loan officer should be able to guide you through different ways to structure it. FHA versus conventional 3% down versus 5% down, paying off debt and doing a 5% down, not paying off all your debt and doing a 15% down. Mm-hmm. That's what that process should look like. It should be collaborative of you explaining what your goals are, what your thoughts are with carrying this debt. Do we have a plan for it? I mean, I have people sell homes, walk away with $200,000 and they're carrying $70,000 of student loan debt. And from a distance, you might go, hey, let's just pay that off. Like, whew, bro, 18 months, it's going to be forgiven. I'm in the public servant loan forgiveness program. So you have a plan. You know what your knowledge and information and plan is for your path. Your mortgage professional should be looking at that. So again, a lot of times people will get frustrated. Why are you asking for all this documentation? Why are you asking these things? You don't need that to get me pre-approved. Well, if you want a transactional relationship with someone who can give you a good deal on something that may not be the best fit for you, take that approach of going with your order for an FHA loan or a 5% down conventional and say, who can fulfill my order at the lowest price? I would suggest you work with an advisor who can pull all the information out of you, your goals, objectives, and plans, your assets, what you have available to you, and help you lay out a roadmap of 1 to 3 options that you can pick from and go, that's the one that I want.
Solid advice. So with that, guys, if you haven't done so already, hit the thumbs up, subscribe to the channel. Until next time, buy right, borrow smart, build wealth. Adios.
Amigos.